Hello all, this is Adam. He's a specialist in cost segregation, a very unique niche in taxes, and he's going to let us know more about that. So Adam, the stage is for you, and educate us.
Sure.
Good evening.
Okay. I want to thank you for having me on here. I'm going to give us a run through of cost segregation. As I understand, you folks are all into real estate and investing in real estate.
Yeah.
Okay, got it.
Mhm.
Okay, great. All right, just trying to get the picture. Okay, so I'm Adam Holkauer. I've been working with Madison Specs for a year or more. The company has been going on for about 15 years. We don't just do cost segregation, we also do title insurance and due diligence and some other assets. But my corner is cost segregation. Cost segregation, I don't know if I'm assuming that we're not familiar with this at all. Cost segregation is the process of getting an IRS-approved engineer-based study. What that means is upfronting your depreciation on your building, resulting in like hundreds of thousands of dollars in tax benefits and not having to pay taxes for that year and maybe even a couple of years after. So, sorry, just changing a setting. There
Okay, now I
go.
open you an option to share. So if you want to share something, you are welcome.
Sure, let's try it.
Yeah, if you want to share a file or a folder or whatever, you can share.
Is it should I just share my screen first and then I'll share the
You can
file
share the
afterwards?
screen and then we can see exactly what you want to show us. Okay. Yeah.
Got you. Right. So this is starting from the beginning over here.
Okay.
Wait. Okay. I'm good at saving you on taxes, not necessarily PowerPoint presentations, but we'll see. So right, it's cost segregation. We're doing an overview. We
Just
answer the
general
question.
information a little bit, Adam. Where are you located?
So we're located in Lakewood, New Jersey. Yeah. Sometimes I make it over to Eretz Israel, but otherwise we're based in.
And obviously you're a Jewish, so you have like some credits with us.
Yeah, it's good. It's like Jews, right? We don't care about each other, who will, right?
Yeah,
like,
exactly.
Every day the media is letting us know that.
Okay.
Yeah. I'm originally from New York. I don't know how much we want to go into that. Spent time in Baltimore. Spent time in Israel. Back over here in New Jersey. Just excited to share the information. Okay. All right, so jumping back in, right, to cost segregation. It's way more exciting than I'm coming off right now. My wife is due to deliver in about a month, and that comes with, helping to watch the kids at night. So forgive me if I'm a little not fully awake. That this this does not contradict the amount of enthusiasm that I have to share about this amazing, wonderful tax benefit. So let's jump in, shall we? So I said the cost segregation is an IRS-approved engineer-based study. To break that down, right? That also means that it's an engineer-based study that upfronts the depreciation. So when you buy a building, which hopefully everyone here will be buying lots and lots of buildings, the IRS says, okay, over the course of either 39 years or 27 and a half years, you can depreciate the building. You can write off the purchase price minus the land tax, right? And so you get that back off your taxes over that amount of time. What this method does is that it accelerates it speeds it up. So instead of waiting all that time, you can get a much larger portion of that in the first year of buying. So a cost segregation study, right? Let's just jump ahead a little bit, right? We can see there are lots of different properties that are eligible. lots of different studies. There are lots of different assets that can be depreciated when someone buys, let's say, an office building, right? They might spend $1 million on it and get that back only after 39 years, excuse me. So what cost segregation allows is for our engineers to walk through the property, right? They come in and they see tables, chairs, they see carpeting, they see vinyl flooring if it's there, they see AC and heating, they see portions of plumbing, all types of what we call 5-year assets. These assets can then be depreciated or written off on your taxes, right? Our engineer also goes outside and they see landscaping and parking and any type of signage as outside as well, and those all get price tags. So, to give an example, anyone who has property in Florida, if they own palm trees that are the outside palm trees, they go for about, I think, $3,000 a tree. Just off the top of my head.
Really, a tree can be depreciated?
Yes.
Wow.
Absolutely. Yeah, it's there's a lot that can be written off. Absolutely a lot. This all has to come at the time of purchase, which is why I'm the first one on here is a purchase study, the first category. If you're doing what's called renovations, that lends itself to be a different study altogether, but we're going to get there. So basically the numbers that we're looking at is 10 to 15% reclass. Often the times it's usually 20% reclass. So like I said, if we have $1 million property, you're looking at closer to between $150,000 and $200,000 in depreciation.
Well, now just let us understand. Sorry, I will have questions during the way, like depreciation, sure. Meaning like it is a loss, but not an actual loss. It's lost on paper.
So yes, exactly. As in, right, what does it mean?
It's not expense like I don't know, paying like property taxes or like paying insurance. It's lost on paper because things are being depreciated, like they are becoming older during the years.
Exactly. So it counts against your net income. So if someone made $200,000 or $100,000 that year, this would count as a loss, and then at the end is what gets taxed. So in some cases, that number can sometimes be zero, and then you're just not taxed that year. So it's a really amazing benefit.
A very powerful tool that you have only in real estate, I think.
Yeah. From what I understand, I think different things can be depreciated in one person's business, and but in terms of property, that's what I'm talking about.
Okay.
Over here. Yep. Let's jump around here. We spoke briefly about Madison, different things it does. We're talking about different assets. Okay, so getting into different studies. What are the different types of studies? When someone buys a property, right, we use that number to work with. Someone can also be in the process of building their property. I have another client who he's in New Mexico, and he builds his own houses. And so the beauty over there is that if you have all the numbers in front of you, even if it's not 100% finished, we can begin the cost segregation process. This is incredibly relevant right now because we're in the last year of what we call 100% bonus. So let me jump back actually for a second. We're kind of jumping ahead. In 2017, whether you like him or whether you hate him, Donald Trump instituted what was called 100% bonus. 100% bonus means that 5 and 15-year bonus that we were talking about can be taken all in the first year. Typical cost segregation is spread out about over 6 years, giving you a much bigger piece, in those beginning years. But with 100% bonus, you can take it all now. A big misnomer, by the way, to get out of the way, is that just because I'm taking a big piece of the depreciation now doesn't mean that I'm not going to have anything to depreciate over the lifetime of my property. So we're just taking a bigger portion now. You're still going to have what to work with down the line that we map out in the study. The end product of this cost segregation study is a 80 to 140 page document that gets submitted to your accountant, and then they submit it to the IRS. So jumping back over, so we're in the last year of what we call 100%, thanks to our current administration. 100% bonus is set to phase out. That means in 2023, you're looking at only 80% bonus, and then the following year will be 60, and then it'll keep going until it fades out. Unless something
100%
changes.
bonus depreciation, meaning I can take all the depreciation and just apply them on the first year.
Right. And all the 5 and 15%. You can take all that in year one.
And then in the coming years, I cannot use it anymore?
So what's amazing is the answer is there's going to be benefit left over, but there's a larger chunk now, and whatever you don't use in that first year of that chunk can roll over indefinitely for the following years. Now, like I said,
5 years
for indefinite, I mean, until you use that benefit up.
Okay.
The idea, right? So good question. And the other thing I want to clarify is just because in our $1 million example that we accelerated, let's say 200,000, that these numbers can change also wildly depending on what's like on the property. I'm just sort of throwing out like an average. When we lay out these numbers of what's in 100%, in the, let's say, if we're talking about a commercial piece of property, in the 38 other years, you're still going to have a portion of depreciation to come off. And this is, yeah, so we'll just leave it like that. I can pull up an example a bit later. But okay, so yeah, please definitely keep asking questions as they come up.
So basically in the first 5 years, we can depreciate more, but whatever we have left, we can roll it up to, for single family, 27 and a half years.
In the first 6 years is what we call like typical cost segregation. You get a number that's usually bigger than your 100% bonus. And that is spread over 6 years. Right now, in the next year or two, you're going to have what's called 100, like a bigger bonus. And so that bigger bonus is what you can take in year one after you file. The idea is that if people are concerned about not using all of that benefit, it rolls over. And so you can use it, whatever you don't use can be used up the following year, and so on.
Okay. There are any benefits to do the cost segregation at the same year of purchasing the house, or it can be a year after, calendar year?
I mean, you have all the benefits of using it right away. I would say it like, and you can also wait a year should you need to, for whatever reason.
I've been told from a cost segregation company that if I'm going to wait for the following year, it will involve extra $1,500 fees, $1,500 fees in something. Can you clear that up?
Sure. Well, okay. So I can only speak for me. I don't know. Know. I think as Michael has found out from him and I, taking a look at some of his properties, we here at Madison, we're not going to try to do a study with you and run away with your money and cheat you. I think what the guy is talking to you about is what's called having to file a 3115 form or 3115. And the idea is if I do what's called a look back study, that means if I did a cost segregation study, not in the first year of purchase, but I did it like 2 more years, you know what I'm saying? Then I would have to go back and file this form. But what we do is we actually fill that form out for you and give it to your accountant with everything else. So so I would say that like it would come down really there to like if your accountant is going to understand we did all the work or if he thinks he still needs to charge you a fee.
Okay, and when you said in the same year, for example, if I purchase a house on May 2022, I'm sorry, if I do the cost segregation study on January of 2023, is that considered still the same year or?
Very good question. So that is a different year. And that and that question is so good, it actually makes a practical difference